Hello students, this is Professor Vincent Saga. Welcome to my class. This is the presentation of part 1 of chapter 2. Chapter 2, recording business transactions. In chapter 1, we talked about accounting and the business environment. So we talked about the overview of accounting and the environment in which accounting operates in. We talked about several issues are also in chapter 1. We said that the main objective for the whole course is to learn accounting rules or accounting principles, also learn how to apply them in order for us to create or generate useful information that can be used for making different business decisions. So that being said, here is something here that is very important that you need to pay attention to. Now in chapter 1, we did talk about recording business transactions, and we recorded several business transactions, and we used the accounting equation format in recording the business transactions. So upon the completion of recording all those business transactions, ultimately we prepared a set of financial statements, or what we call financial report. All right, and that is the information that we produce at the end of the day. So in chapter 2, we are also recording business transactions, but this time we are recording business transactions the way we actually do it in real life, not using accounting equation layout or format. Now that being said, it is very important at this point in time for you to understand the importance of committing into memory the different terminology. Okay, as you are going to see, we have a lot of terminology in this course, and a key to understanding or doing well in this course is being comfortable with the different terms that we are going to discuss. So now, what is a transaction? What is a business transaction? In chapter 1, we said that a transaction is an event whereby an exchange takes place. So every company engages in several transactions on a daily, weekly basis. Transactions between customers, transactions between vendors, transactions between employees, so on and so forth, and transactions between the owners of the company. So we have 5 learning objectives in chapter 2. So let's take a look at the first one. Here we are going to explain accounts as they relate to the accounting equation and describe common accounts. So as we established in chapter 1, we said that the accounting equation consists of assets equals to liabilities plus owner's equity or plus equity. So those are the 3 parts of the accounting equation. Now let's take a look at the question here. What is an account? You know, here we are told that an account is a detailed record of all increases and decreases that are occurred in an account during a specified period. Now, what does that mean? In other words, an account is a record that we use to keep track of different things relative to our business operation. So let me give you an example of an account. Think about your checking account at the bank. A bank will set up your checking account, and your checking account is a record of all your transactions. So when you make a deposit, withdraw money from your checking account, the bank will keep track of the detail of all the activities in your account. So in business, a company has several accounts relative to these 3 elements or 3 parts of the accounting equation. So the account is a detailed record of increases and decreases. Now, having said that, let's take a look at different examples of the 3 parts of the accounting equation. Number 1, assets. We talked about the definition of assets in chapter 1. We said that an asset is anything that has a value that is owned by a company is an asset. Okay, here are different examples of assets. Cash, that is self-explanatory. Cash is an asset, and we need to have a separate account for cash and keep track of the cash of the company. Then we have accounts receivable. That is the account that we use to keep track of what people owe us, what customers owe us. We say accounts receivable. So that is the money that we are going to receive in the future. Then we have notes receivable. That is a written promise by another party to pay the company in the future. Then we have prepaid expenses. Now these are expenses that the company pay ahead of time. In other words, if we are obligated to pay $1,000 in insurance every month and we decided to pay $12,000 ahead of time, or $12,000 for the whole year, then we have prepaid insurance expense for the whole year. So prepaid expense is an asset. That $12,000 belongs to the company. It's an asset until the company use it up or some of it up. Then furniture, equipment is another type, land, building, those are self-explanatory, so on and so forth. Now let's take a look at the second part of the accounting equation, liabilities. Here we have different accounts. Accounts payable. Those are the company's promises to pay vendors or other parties. So if a company buys something on credit or without paying cash, the company is obligated to another person. So the company needs to keep track of it in a particular account, and we call that accounts payable. Then we also have notes payable. That is a situation whereby our company put the promise to pay in writing to another third party, So we keep track of that separately from accounts payable. So accounts payable is oral, verbal promise to pay. Notes payable are our promises to pay other party in the future. Now we have accrued liability. Amount not owned but not paid. In other words, we owe somebody, we haven't paid yet. So for example, at the end of the month, our rent is $5,000 and we don't have enough cash to pay our landlord. So we call that accrued liability. So it's an obligation that we are going to pay in the future. Then we also have unearned revenue. What does that mean? That is a situation whereby a customer pays us ahead of time. So if we have to provide $3,000 worth of service to a customer for 3 months and the customer gave us $9,000 from the get-go, so what are we going to say? I said, well, we don't want to keep your $9,000 right now because we haven't done any work for you. Of course, we are not going to say that, because you are better off receiving money from the customer ahead of time than having to chase them around after you have provided services. So of course, we take the $9,000 to provide $3,000 worth of service every month for 3 months. When we receive that $9,000 from the outset, as far as the company is concerned, that $9,000 is an obligation, it's a liability, it's a debt that the company owes to the customer until we provide services. So at the end of the first month, when we provide $3,000 worth of service, then we have earned 3 out of the $9,000. So at that point in time, we only owe $6,000. So we're going to talk more about that eventually. Then we have the third part of the accounting equation, that is the equity. Now here are different accounts under equity. We have common stock. We have already talked about that. We track the owner's investment in an account called common stock. Then we have dividends. Those are a distribution of the company's profits to the owners. We call those dividends. Revenues, we talked about that. Those are the money that the company generates or earn either for delivering services or selling goods. And of course, expenses are the cost of doing business, okay? So we have to keep track of all of this. Now, moving along, let's take a look at the chart of accounts. Chart of accounts. Now, what is chart of account? First of all, you need to know this. In real life, accountants use several records or books to keep track of a lot of things or to record transactions. What do I mean by that? This is a book, okay? So just assume that this is a big notebook and this is a record. So when a transaction happens, we record the transaction in a book. It could be a book like this, it could be a loose leaf binder. Nowadays, more often than not, everything is automated. Almost everything is recorded in the computer. So we have several books that we use to record business transactions. I want you to know from the outset, different accounting books or records are used for different purposes. The first book that we use to record every business transaction is called the General Journal. That is the very first book. So every transaction has to be recorded, first of all, in this accounting record called General Journal. Okay, we call it the first book of original entry. Now, we'll discuss that in detail in Objective 3. Now, that being said, let's take a look at another record. We have another book or record, we call this the ledger. With the ledger, think about the ledger as a book with each page devoted specifically for a particular account. Let me give you an example. Let's assume that we are in a bank and the bank have 2,000 customers and the bank devoted one page for each customer's account. So you have this big book with 2,000 pages, one page for each customer. So we call this customer's ledger. So a ledger is a book, is an accounting book that keeps track of different accounts on each page. In other words, each account is the detail or the increases and decreases of a particular account. All those increases and decreases are kept on a particular page. So we call that the ledger. So as you can see, the General Journal is one type of accounting book. The ledger is another type of accounting book or record. All right? Now, let's take a look at this. A chart of account. What is a chart of account? A chart of account is more or less like a table of content of a book. So remember the example that I just gave you? We have 2,000 customers here. In order for us to find each customer's page easily, we can take a look at the table of content. So a chart of account is more or less the table of content of a ledger. So now let's take a look at Objective 2. So at this point in time, we are going to wrap up part 1 of this presentation, and we are going to start part 2 with the second objective.